Welcome to Talk Tickers. We analyze the metrics that move markets, and today we're cutting through one of the most complex yet common practices in modern corporate finance, the share buyback.
It's everywhere.
Absolutely everywhere. For decades now, buybacks haven't just been a way to return capital to shareholders.
No, they've become the dominant way.
The numbers are just staggering. Between 2010 and 2019, U.S. firms pushed out something like $6 trillion in buybacks.
$6 trillion, that's more than they paid in dividends.
So when you see a number that big, you just have to ask the question. Is this a sign of genuine confidence, smart capital allocation?
Or is it something else? Is it a financially engineered tool that's really just there to boost executive pay?
That's the core of it.
It really is a classic financial dilemma. And it all kind of kicked off with a regulatory change, actually. Back in 1982, the SEC enacted Rule 10b-18.
And that gave companies a safe harbor.
Exactly. A safe harbor from claims of market manipulation when they're buying their own stock.
Aye.
And that's when repurchases just exploded. So today our mission is to, get past the simple good or bad narrative.
Right. We want to dig into the mechanics, find the hidden incentives, and I think most surprisingly, really expose the hidden costs in how these things are actually executed.
The execution is where so much value gets lost.
Okay, so let's start with the absolute basics. For anyone who maybe isn't staring at an earnings statement every day, what's the fundamental mechanism here? What makes buybacks so attractive on paper?
It really is just simple arithmetic. A company uses its cash to buy its own shares on the open market.
Which reduces the number of shares outstanding.
Right. And that's the key, because the big metric everyone watches, earnings per share or EPS, is just total profit divided by the number of shares.
So if your profit stays the same, but you shrink the denominator,
your EPS goes up automatically. It's a mathematical certainty. And the market often rewards a rising EPS.
So when a management team is deciding what to do with its cash, reinvest, pay a dividend, or buy back stock, what are let's say, the textbook justifications for a buyback?
Well, we see about three main camps, three motivations. The first one is what you could call the value camp.
Okay, the value camp.
These are managers who genuinely believe their stock is trading for less than it's worth, below its intrinsic value.
So for them, buying their own stock is the best possible investment they can make with that cash.
Exactly. It's a signal of confidence, disciplined capital allocation.
What's the second camp?
The second is the excess capital camp. They see buybacks as a really flexible and tax-efficient way to return cash to shareholders.
More flexible than dividends, you mean?
Much more. Dividends are sticky. Once you start paying a certain amount, the market expects it. If you cut it, your stock gets hammered.
But a buyback program can just be suspended.
Without nearly the same panic. It gives them options, especially if the economy turns down.
And the third camp, you mentioned this one is more about the balance sheet itself.
Right. This is the leverage manager camp. For these firms, it's not really about the stock price or even returning cash. It's about hitting a specific leverage target.
How do they work?
They use cash to reduce their equity, which in turn increases their debt to equity ratio. It's a tool to reshape their capital structure. And this has had a huge effect.
Huge.
Between 2010 and 2019, for U.S. non-financial companies, the median leverage jumped from 21% to 32% of book assets. Buybacks were the main driver.
That's a massive structural shift. It almost feels like the conversation shouldn't just be about buybacks, but about the high levels of corporate debt they're creating.
I think that's exactly right. The buyback is the tool, but the real underlying concern for you as an investor should probably be the level of financial risk, the resilience of these companies.
Okay, so this brings us right to that core tension. If the math is so simple, buy shares, boost EPS, it feels right for gaming the system. Is there real evidence managers use this to hit their personal bonus targets?
The evidence is pretty compelling. The data shows a powerful documented link
between buybacks and pay.
Yes. In one large sample of firms, around 49%, so almost half, had CEO bonus plans tied directly to hitting specific EPS goals.
So the incentive is baked right into the contract.
It's a massive structural incentive, and we can even put numbers on it. The average buyback ratio is about 3.5% a year.
And that can move the needle on EPS by how much?
By about 11 cents per share, on average. Now, if your bonus depends on hitting a target that was set at the start of the year,
that 11-cent bump could be the difference between getting a huge payout and getting nothing.
Precisely. We're talking about a very powerful, very direct financial incentive.
So the motivation shifts from, our stock has a great value to I really need to hit my EPS number. That sounds like opportunistic manipulation.
That's the term for it.
And does that come at a real economic cost? I mean, is it hurting the company's long-term health?
Absolutely. And that's the most alarming part. When managers do these opportunistic repurchases, they're pulling cash away from productive long-term investments.
Like what?
The data shows clear negative effects in the following year. These same firms significantly reduce employment, they cut back on capital expenditures, and critically, they slash R&D spending.
So they're selling off the company's future growth engine just to make the current quarter's numbers look better.
It's a devastating trade-off.
Wow. Has there been any regulatory pushback on this? Anything that's worked?
There has, actually. In 2003, the SEC amended that same rule, 10b-18, and they mandated much greater disclosure about repurchases.
And sunlight is the best disinfectant.
It seems so. After that amendment, these opportunistic EPS gaming buybacks, they declined. And more importantly, those negative real effects, the cuts to R&D and investment, they were either reduced or they disappeared entirely.
So scrutiny works.
It really seems to curb the worst of the behavior.
Okay, so that covers the why, the decision making.
Yeah.
But now we have to get into the how these trades are actually executed. And this is where things get really complicated and where a lot of shareholders are losing out without even knowing it.
It's a huge blind spot.
When a company announces a buyback, the execution can take months, right? What's the main risk during that long window?
The main risk is simply price risk. It's driven by two things: how volatile your stock is and how long you're exposed to the market.
Can you give us an idea of the scale?
Sure. Think about a typical buyback. It might run for 125 trading days, so about 6 months. If that stock has a 35% annualized volatility, which is not unusual, that company is exposed to a potential 50% price swing during the buyback period.
A 50% range.
Yeah.
That's a huge risk. If you're in that value camp and you truly think your stock is a bargain.
Then the logical thing to do is to buy the shares as quickly and efficiently as you can. Lock in that low price, minimize your exposure.
But that's not what happens.
Very often, no. Prolonged executions are extremely common, and they're often tied to the flawed way the brokers who manage the buyback are paid.
And this gets us to the centerpiece of this problem, the measurement tool that has been called the bogus benchmark. What is this thing, and why is it so bogus?
Okay, it's a bit technical, but the conflict is fundamental. Most big institutional trades are benchmarked against something called the volume-weighted average price, or VWAP.
VWAP. I've heard that.
Right. It's the average price of a stock over a day, but it's weighted by trading volume. It's the robust industry standard.
But that's not what's used in these buyback contracts.
In many of them, no. They use this weaker metric, the bogus benchmark. And it is the simple arithmetic average of the daily VWAPs over the whole execution period.
Wait, arithmetic average versus volume-weighted average. That sounds like a tiny detail.
No, it sounds tiny, but it's the entire game. It's the hinge on which the broker's profit swings.
Explain that. How does that small difference create such a big problem?
Okay, think of it this way. Let's say you need to buy 100 gallons of gas over a week. A true VWAP would tell you the average price you actually paid for all 100 gallons.
Okay.
The bogus benchmark just looks at the price on the sign each day and takes a simple average. It doesn't care if you bought 90 gallons on Monday when it was cheap and only 10 on Friday when it was expensive.
I see. It ignores when the volume actually happened. So how does the broker use that to their advantage?
Because it gives them control over the timing of completion. The contract incentivizes them to beat this simple average, so they can strategically slow down or even stop the buying when it maximizes their outperformance fee.
So they can manipulate their own performance metric.
They absolutely can. And statistically, the odds are stacked in their favor. It's almost guaranteed that they will outperform the simple benchmark, especially if they control the end date. The contract is basically set up for the broker to win a bonus.
And this means the fees must be huge.
Astronomical. The frictional costs from these VWAP guarantee or VWAP minus products can be 30 to 100 times higher than a simple agency fee.
100 times higher.
Yes, because the broker is being paid to optimize a metric that might actually harm the shareholder, forcing the company to pay a slightly higher average price overall just so the broker can collect a massive performance fee.
Let's quantify this. What's the scale of value that's being put at risk by this flawed execution strategy?
It's immense. In 2022 alone, we're talking about roughly $280 billion worth of buybacks executed using these strategies.
$280 billion.
And at the start of those programs, that represented about $70 billion in shareholder value at risk, or VAR. That's value that's being improperly managed because the incentives are all wrong.
$70 billion. That is just staggering. Let's make this real. You've got a couple of case studies in the UK that really highlight this. Let's talk about the fee trap.
Okay, so this first case is a FTSE 250 company. They launched a $200 million buyback, and during the execution period, their share price actually fell sharply.
Which should be great news, right? You're a buyer, the price is dropping, you can buy more shares for your money.
It should have been a fantastic outcome. But because of the flawed contract, the company ended up paying a fee of about 8.6%.
8.6%. That's $15.7 million. Why?
Because the contract was structured to maximize the broker's performance fee against that bogus benchmark. The falling price made it incredibly easy for the broker to outperform the simple daily average.
So the company paid a massive premium for a benefit that was essentially worthless.
Exactly. The shareholder got zero additional value, but incurred this enormous cost.
It's counterintuitive. The price goes down and the fee goes up. What about the other example, when the price went up?
That was a FTSE 100 company with a $435 million program. The broker started out fine, buying about 90% of the shares when the stock was weak.
Okay, so far so good.
But then, as the stock price started to rally hard near the end of the window, the broker dramatically slowed down the buying of that final 10%.
Wait, if the stock is rallying, you want to buy faster, not slower. Why would they delay?
They delayed because it widened their performance gap against the bogus benchmark. By trading less and less each day as the price climbed, they made their outperformance metric look much better. It went from about 1% to 3.5%.
Which means they got a bigger fee.
A much bigger fee. The total fee ended up being about £10 million. And at the same time, because they were dragging it out at higher prices, the shareholders' actual average purchase price went up slightly.
So in both cases, price falling or price rising, broker wins and the shareholder pays.
In both cases, the broker optimizes their metric, and the corporate shareholder bears a significant, totally unnecessary cost.
So what we've really established is that this isn't just an accounting issue. It's a behavioral finance problem and an execution integrity problem.
That's it, exactly. The structure creates this inherent conflict of interest. The broker is incentivized to do things that run directly counter to what's best for you, the shareholder.
The primary goals of just maximizing the shares you buy or minimizing the cost.
Those goals become secondary. The takeaway for investors is you can't just assume the execution phase is passive. If a company chooses one of these VWAP guarantee products, they are setting up a scenario where their broker will almost certainly be paid excessively for, at best, marginal performance.
So we've seen today that buybacks are so layered, they're a tool for managing leverage, they can be a signal of undervaluation, and
far too often a very effective way to just hit executive bonus targets.
For investors trying to sort this all out, what's the checklist? What should you be looking for?
I think it's three things. First, you have to separate EPS growth from true earnings growth. If a buyback is doing all the heavy lifting for EPS, you should be very skeptical.
Okay, what's second?
Second, check the price discipline. Is the company actually buying its stock when it's cheap, below intrinsic value, or are they just buying at any price, even at market peaks, just to hit that EPS goal?
And the third, the execution.
Exactly. You have to question the execution strategy itself. Demand transparency on the frictional costs, because as we've seen, they can completely wipe out the intended benefit of the buyback.
And while so much of the debate is about that EPS number, you're really suggesting the biggest concern should be what's left behind on the balance sheet.
That's right. I mean, we should be mindful of buybacks as a leverage tool, but the real focus should be on that final leverage level.
Because that's what determines resilience.
It is. If you just look back to the shock of March 2020, it was a harsh spotlight. The firms that had used buybacks to lever up their balance sheets struggled far more than their low-leverage peers.
Regardless of how much stock they'd bought back before.
Irrespective. So that leaves us with a final thought. If financial resilience is the ultimate measure of a company's health, should the investment community maybe stop obsessing over the short-term sugar rush of EPS accretion from repurchases?
And focus almost entirely on demanding prudent, sensible leverage management.
It's a question worth asking.
A critical thought to end on. The true cost of financial engineering often only shows up when the markets turn south. Thank you for joining us for this deep dive. We hope this gives you the tools to analyze which companies are truly allocating capital wisely and which are just performing financial magic tricks.